So what are you telling your clients now at this current juncture? It's been very easy. If you bought gold, you've made money. You bought equities, you've made money. Fixed income has given great returns. And even real estate has appreciated.
Yes.
So in this market, if somebody is looking at generating superior returns when everything is at an all-time high, how should one approach the market?
Basically, if everything has made money, you ought to be now cautious that, and our job is to figure if something is wrong somewhere. So you would say that as of right now, given that economies across the world, more specifically in US, is slowing. Also in India, you have some kinks. It's sort of fairly plausible that rates go further down. As we've discussed a couple of times in last 6-8 months, that rates in India could get to 5.5 or thereabouts. So there is still a runway there. I think I like that space. I think the bond yields in India will be sharply lower in next 1-2 years, perhaps even lower than what we saw in COVID. Gold could be a small allocation. Again, it likes the fact that real yields in US will come down. So therefore, it's done really well already. So to that extent, you should be cautious there, because gold, you have to be worried that it tends to get into these phases where for a long time it doesn't perform. So you never scale the allocation there. There's no coupon in gold, right? So be careful there. Equity is a space where there's a lot of momentum. The margins sort of remains high both in US and India. But the revenue sort of has started to come off. Even EBITDA and PAT sort of in India, last quarter numbers were not that great. So you ought to be cautious, that remains my view. Now, when
so cautious on equities?
Yes.
Bullish on bonds?
Very bullish on bonds.
And neutral on gold?
Neutral on gold. And I can actually, because, we've launched this strategy, I think, from a purely, because I'm more of a macro, top-down, what is good guy. And I think it's sort of reasonable to assume that even though India enters in a slowdown, because it's likely that Indian balance sheets are so clean that the slowdown won't hurt them much. So even though the pressure on P&L appears, the margins will come down and disappoint equity markets. Balance sheets are squeaky clean, and therefore they'll be able to service the loans. So if you can get great opportunities in lending, I think there is a decent risk premium to make. My sense is that people who can afford and can move to high yield strategies, ours and many other such strategies exist. I think it's a better place to hide yourself. That's the way to actually play growth or play extra risk premium versus equity right now.